Hello and welcome to this four-part video series, The Self-Employed Debate in Conversation with Together. I'm Samantha Partington, freelance journalist for Mortgage Solutions, and today I'm joined by Together's Maeve Ward, Head of Intermediary Sales, Personal Finance, and Nick Parker, Head of Networks and Clubs, and their guests, Paul Zammit, CEO of the Loans Engine, and Greg Cunnington, Head of Strategic Accounts at Legal & General. In part one, we looked at the self-employed landscape in 2025 and the opportunities and challenges within the market. In our second segment, we're focusing on the borrower themselves and the complexities of their circumstances. So, Greg, I'd like to come to you first to kick things off. Why do self-employed borrowers face challenges when they apply for mortgage finance?
Hi, Sam. Great question. I think a lot of it is what's perceived as complexity in the scenarios. Part of it is then lender appetite and systems. Part of it is a desire to kind of really understand the self-employed customer. And I think that's where the specialist lending landscape really kind of plays into its own. And I think of certain scenarios, one really off the top of my head, which is very basic and straightforward, but comes up every year, is obviously for your self-employed customer, you do your tax return deadline in January. But most lenders require things to be dated in the last 18 months. So every year at mortgage intermediaries, you have this strange period between October and January where you can't get a mortgage with the top 20 lenders. So these customers can't get the best products, but they're doing exactly what their tax advisor and accountant has told them to do. And they're sat there not ready to even start the paperwork until December. So straight away, you've got a conflict between mortgage criteria and the actual day-to-day lifestyle of the self-employed customer. Another obvious example would be a limited company director, which a lot of the data we see is really where a lot of this marketplace has gone. And there's been a big trend in kind of sole traders moving into the limited company space. Of course, typically you retain most of your income as net profits, which in fairness, more and more of the lending world has kind of got their head around, but you still get some who only lend on salary and dividends. So again, there's kind of a restriction there. But then also there's various things in terms of putting money into pension schemes and just wanting to get into the detail of the accounts and the customer's actual financial situation and affairs, where let's be realistic, if you're a top six lender looking to do thousands and thousands of mortgage applications every month, actually you can't build an operational process to do that level of detail and holistic underwriting and understanding. So we do have to empathise with the lender landscape as well, but it means for this part of the market, there'll always be a need for manual underwriting for lenders who can actually look directly at these cases. And I always remember one scenario we had where one lender, the lender with the best rate the customer wanted, I think would offer £100,000, and a specialist lender would offer about 900,000. Same customer, same accounts, just a different way of assessing the income. And it's really extreme, and explaining that to a client is crazy, isn't it? But it does mean there's huge opportunity. I dug out some stats this morning from our Ignite tool on the criteria and affordability searches, and of the last 11, there'd been over 11,000 searches in the last 90 days on income. 6 of the top 8 searches were self-employed. So again, when looking at opportunity, this is where customers and advisors really need the help and are looking at things. Really interestingly then, 39% of those scenarios were a yes, here's a list of lenders who do this. 11% were a maybe. So you've got 50% of the cases where it went, okay, there should be a home here. 50% based on the whole lending landscape criteria were a no. Now, first of all, that says there's huge opportunity. Secondly, it shows why intermediaries need to be set up with the specialist lenders and know who will look at these cases.
So, Nick, how do cases like this, with the complexities that Greg's just outlined for us, how do the cases like that play to the strengths of a specialist mortgage lender, and why?
Most of your high street lenders don't have the operational capability and capacity to be able to process and listen to a story. The high street lender's worst enemy is a notes section, because it takes them away from the formulaic field-based, that gives you that automated decision. As soon as you start putting notes into a system, somebody's got to read them. And this is where the high street probably isn't as strong as specialist lenders, because we want those stories. We want the notes because that helps to bring to life what's happening for our specialist underwriters.
Maeve, one of the stats that jumped out at me from your residential property report was that 22% of rejected applicants who fall outside traditional lending criteria believed that they were turned down because they were self-employed. Why do you think that is?
The stats doesn't surprise me, actually. I think it's a combination of what Greg and Nick were just talking about. It's because of the algorithm of the high street. For more than one variable, you just can't get through, and there isn't anybody there having a look at or listening to the story or truly lifting the bonnet to understand the customer's circumstances, to actually get comfortable as to whether or not they could find a solution and provide a good lending outcome. I think it's fair to say that, we've all sort of articulated it. There is the perception that self-employed does carry a greater risk. And I guess it does, because you've got income gaps, you've got multiple income streams, you've got complicated structures, which for the high street, it makes proving affordability quite hard. And actually, it takes a lot of bandwidth and a lot of people and a lot of experience in interpreting accounts to do that. And they're just not set up outside of vanilla to enable that to be something that they can consider. Put that all together with the rise of non-standard, and again, the residential market report talks a lot of what is a non-standard borrower. It is your self-employed, it is the age, it is the credit score, it is the length of time they've been employed, or perhaps their property type. It's a combination of things. So generally speaking, I think it would be for more than one reason that these applications were declined, other than them just purely being self-employed.
Paul, I thought it would be interesting just to hear from you of some perhaps recent examples of self-employed scenarios that you've seen that you can see clearly represent a sound lending opportunity, but they would have been rejected by the high street.
Yeah, do you know, it's ironic, actually. Greg mentioned at the start two things, actually. That sort of gap, in their tax year, not necessarily a gap, but I guess obviously when they've been advised to file their returns, and actually when the lender's expecting to see the return. So if you take together, for example, and again, you can look at a purchase, remortgage, or capital raised by way of second charge, they'll look at a projection of income for the forthcoming year. That's not something that many lenders offer. And if then you couple that with someone that might be in a situation where they have just a very light blip on their credit report, there's two things there that, first and foremost, the projection of income is something that is very, very few lenders will overcome. And when we talk about a blip on the credit report, put them two together, even if you wanted to refer it to, not let's just say one of the top six, but a challenger bank, it just gets blown out of water straight away.
Paul, just to stay with you for a moment, what do you do if you do get a case, you can see that it's a good lending opportunity, but technically it falls outside some of the criteria for one of the specialist lenders? As a packager, how do you approach this when you can see that there is a good opportunity there?
Yeah, it's the great thing about working with the likes of a lender like Together is you just pick up the phone. Whether it's Maeve or whether it's Nick or it's someone, field-based, they will pick up. Where the good thing about a master broker packager is that, they'll never try and flog a dead horse. There's no point trying to push something through if in your heart of hearts you know that it's just not a sound lending decision, all the stuff that we've talked about today. So there's three key things. From Together's perspective, okay, what's the loan to value? Now, Together currently lends 75%, so actually they've mitigated the risk quite nicely there. Second of all, it's the credit profile, because on one hand, you're trying to put through a case or a referral on the basis of the income's looking great, it's going to be great going forward. Actually, we talk about the story, as Nick alluded to earlier. If the credit profile isn't the best and you've got recent mispayments occurring on the report, then actually there is that discrepancy. So then your referral just falls apart. So, in the first instance, we personally, of course, would look at it from a lending point of view. Again, as Greg mentioned, would I lend my money? If I would, you've got a good case to put through. We'd pick up the phone. In some circumstances, of course, it's, it sounds good to me, but refer it on the portal. But I would say 8 out of 10 times that case would go through if we're at the loans engine referring it through.
I thought it would be good to end on some tips that we could give brokers. I hope, Greg, maybe you could help us out with this one. What tips would you give brokers when it comes to the best way to present a complex self-employed case, like some of the scenarios that have been discussed, so you can get the best chance of a positive outcome with the lender?
Yeah, really good question again. And listening to some of those case scenarios that Paul ran through, it really brings that question to life. For me, it's know your customer. So really fact find them. I think where sometimes there's a struggle is if an advisor has done their normal 20-minute fact find, assuming it's quite a vanilla case, and then suddenly gets a decline on a couple of dips and is really confused as to why. Actually, if you deal with this kind of case scenario day in, day out, so advisors who specialize in complex self-employed, buy-to-let, high net worth, expat offshore, they're all very similar in terms of just needing the whole picture of the customer, and then pick out these points, and that way there'll be no nasty surprises or skeletons, and make sure you upskill and educate yourself with a lot of the sessions these lenders can do in knowing what to look for. And secondly, it's presenting it transparently. I hear from lenders all the time, frustration is when an advisor goes, I've got this amazing case, here you go. You'd be crazy not to do it. And then a week in, they go, exactly as Paul's point, hang on, this is grade 2 listed and they've got a CCJ. You go, yeah, but it's a great case. And you kind of go, no, it's the opposite. It's work with these lenders. They know this part of the market. Explain from the first minute, I've got this case. The reason I'm discussing it with you, not top 6 lender here, despite their income profile, is X, Y, and Z. I personally vetted this and still think this is a no-brainer for you, but can we look over this together and what are your thoughts?
Thanks, Greg. That's all we've got time for today. I'd like to thank my guests, Maeve, Nick, Paul, and Greg. And please join us next time when the panel will be sharing invaluable insight into how underwriters think when they're assessing a self-employed application.